All right, good morning. I'm with George Ogilvie, CEO of Arizona Sonoran Copper, ASCU on the TSX. Good morning, George. How are you?
Hey, I'm well, thank you, Robert. How are you?
Excellent. Arizona Sonoran recently put out its maiden pre-feasibility study, so a major milestone. And then just yesterday, the market moves a bit, so we're a little lower today. But yesterday, the share price actually hit $4 per share. So I want to say congratulations.
Yeah, thank you.
Before we get into the pre-feasibility study and look to the future, as we always do in these conversations, let's go back in time. Let's go back 4 years to 2021 when you took the helm as CEO of the company. You know, when you became CEO, I'm sure you set some goals. I'm sure you had some expectations for how things might go. How do you think you and the company have fared relative to those expectations that you had all the way back in 2021?
I think we fared actually quite well. I mean, all of my initial expectations have been achieved. It's taken a little bit longer than I would have liked. When I joined this company, I felt that it didn't have many sort of warts, so to speak. It had a lot of positives going for it. Given it was a former producing mine, it was significantly permitted. It had access to water, great infrastructure in the area that would minimize the initial capital. But nobody could have forecast that, we were going to pick up the Mainspring property, which belonged to a private landowner at the time. And that obviously completely transformed the project and the economics. And, the second half of 2024, once we could actually incorporate it into a preliminary economic assessment. So I think overall we did well. It just took a little bit longer than I expected.
Okay. Well, quite frankly, being an investor in the mining sector for over 20 years, I've come to expect that everything takes longer than I expected. It's just the nature of the beast.
Thank you for reminding me of that. Yeah, so true.
I mean, I think the company's progress, look, I think what you've done in 4 years is actually quite exceptional. So to be at this stage with a really sterling pre-feasibility study with great economics and in the position you are is exceptional. So look, let's get into the PFS. Let's dig into the numbers a little bit. Look, your base case is $4.25 per pound copper. I think that's quite conservative considering this mine won't be in production for another 3 or 4 years. I have to expect the copper price will be a lot higher in 2028 or 2029. So the NPV 8% after tax is US $2.3 billion using a $4.25 copper price, and life of mine gross revenue is $17 billion using $4.25. Now, if we use a $5 copper price, which I think is actually more appropriate, the NPV 8 is $3.35 billion, and the life of mine gross revenue is $20 billion. Some people, look, we talked about the positives there. Some people had a little bit of negative commentary on the increase in CapEx. The payback period is now 5.3 years, so it's taking a little longer to pay back the CapEx. Well, what do you have to say on the PFS?
Well, I do think they were exceptional results. It's not very common that you go from a PEA to a PFS and you actually see maintaining or even improving the economics, which we did on this case. Usually there's some destruction of value. So I think it was a phenomenal outcome for us. On the increase in CapEx, just some of the reasons for that, if we can touch on that. We moved the starting position of the open pit at Park Salyer more to the north. That increased the pre-strip by about 25 million tons over and above the PEA. And then the PEA, we also had an MOU with a mining company for a very, very good quality second-hand crushing and conveying system. Unfortunately, the definitive agreement fell apart, and ultimately that mining company decided that they were going to keep that equipment. So we actually had to go out and get quotes for a brand new crushing and conveying system. And that added in approximately an additional $100 million to the upfront capital. And then, of course, over the last year, we have seen some pressure with respect to inflation, no doubt as a result of the tariff policy. But at the end of the day, we still have a project that's financeable and wonderful economics.
So that's interesting you say that about the tariff policy. So does that mean that if the tariffs are, repealed in the next few years, maybe with a change of administration or what have you, that the CapEx might actually be smaller than $977 million?
Yes and no. It's a difficult one. I mean, again, when you go from a PFS to a bankable feasibility study, I would expect the CapEx numbers to marginally slightly increase. But then if the tariffs are removed to offset that, you could see prices coming down. So maybe it balances out. But you raise a great point. I mean, we're conservative in using a $4.25 copper price, whether we have tariffs or not. Once you start to look at this at $5, which is currently where spot is sitting around about today, the economics are off the charts.
Yeah. So let's use that $5 price. So the PFS shows gross revenue over the life of mine at Cactus of 20 billion US using a $5 copper price. What do you believe that is worth? What is that worth to shareholders?
What is that worth to shareholders? That's a great question. Well, look, I mean, we run our own internal models at various copper prices, and I think when we run the base case at $4.25, I think ultimately our NAV per share that we get is north of $8. It's in that type of range. So if you started to look at $5 plus, you're probably well north of $12, $13 a share at those type of prices.
Okay, so look, the share price has traded exceptionally well in 2025. I mean, actually, we spoke at Beaver Creek in September, and I remember I was buying shares in the 250s, thinking this is a great dip buying opportunity ahead of the PFS, and I was right. But actually, I'm impressed that it went all the way to $4. Yeah, the stock is trading really well. What do you attribute the share price strength to?
Well, look, I think definitely putting out these robust numbers in the PFS. I mean, one of the criticisms the project had always received was that, plans were always continually changing. So one of the things that we really focused in on with this PFS is to really simplify the plan and try and duplicate what we had in the first 20 years of the PEA. So I'm sure the listeners will know that in this PFS, we took out all the primary sulfide beyond year 21. There's no underground mining. It's just 2 open pits. And we even took out the historical surface stockpile and are only contemplating using that in the construction of the leaching pad as part of the overliner. So we really simplified the story. And then I think from the macro picture, since you and I last spoke, there's been several mines which have ran into some difficulties with mud rushes and seismic events. It's taken, significant amount of copper off the market in what was already a sort of tightening supply chain anyway. And I think that's what sort of improved the macro picture for copper as well. And a rising tide sort of, causes all boats to rise. So I think we've seen some tailwinds given what's going on in the macro environment as well.
Okay. Yeah, that's true. And actually, I think for me, what the biggest, most attractive aspect of Cactus is the location. I don't think we're going to have any seismic events there in the next 50 years. Of course, I could be wrong, but I don't think so. No mud rushes.
Yeah.
And it couldn't be better from like an infrastructure and workforce standpoint. So that's always been something that attracted me very much to the project and to the company. And even, people that said, oh, well, the metallurgy or, the grade isn't high enough. And it's not true. It's obviously not true. And especially in a rising copper price environment, the economics here are quite robust.
Well, exactly. I mean, we've got 513 million tons of reserves at a 0.52 total percent copper. I mean, that is superior to a lot of the, huge open pits that are currently mined today in Chile, the #1 copper producer in the world. And of course, those open pits have been going for 30, 40 years and are getting rather deep with diminishing grade and rising operating costs. So I think this project stacks up extremely well versus some of its peers around the world.
George, can you just walk us through how the mine, advances throughout the life of mine? What does year 1 to 6, look like? And when is the transition from the oxides and the leachable copper to the sulfides occur?
Yep, so it's a 20 years of mining, and in the first 15 years, essentially, we're mining Park Salier. That really is the value driver on this specific project. Initially, when we look at the CapEx and the SXEW plant, in the first 3 years, we actually construct a 70,000 ton capacity plant. And then between year 3 and 5, we're constructing an additional 70,000 tons of capacity. So what it means is that by year 5, the average annual production is up to 140,000 short tons of copper cathode. And then that continues, I believe, all the way out to year number 13, which is when we start to see the production and the grades waning at Park Salier as production begins to then fall away and come off. And as I said, is extinguished around year 15, year 16. Of course, while that is happening, we then go over to Cactus West, the old Sacaton mine. We begin the pit layback there in and around year 13 and 14. So we start to see first production coming in there to replace what we're losing at Park Salier. And that takes us out another 5 years for 20 years of mining. And then in the last 2 years, we're obviously getting copper still coming off the leaching pads in years 21 and 22. So that's sort of like the mining sequence. It's all open pit mining. 90% of all the mining conducted in Arizona is open pit mining. And Arizona supplies over 70% of the US domestic supply of copper. So we're doing everything that's very simple, very conventional, is no different than what other mining companies are doing today in Arizona.
Okay. And so now looking ahead to 2026, I mean, look, you put a lot of work into this PFS, but this is just kind of how it goes. You publish the PFS and the next day it's stale and it's on to the next thing. So we have a bankable feasibility study with a lot of engineering coming up in 2026. And then obviously the big one is project financing. So what can you tell us about those two things?
Yep. So the bankable feasibility study is basically already underway. We would envisage that by the third quarter of 2026, the bankable feasibility study will be completed and we'll be in a position to release that to the market. And as I said, there'll be some small tweaks perhaps, but nothing is going to materially change between the PFS and the bankable feasibility study. So the process flow sheet remains as is. We know the sequence of mining. We know where the leaching pads are going. We know where the SXEW plant is situated. We know where the waste rock is going and how we're moving that material around the site. We've already started the project financing work stream. 3 months ago, we announced to the market that we had engaged Hannam and Partners out of London in the UK as our project financial advisor. We've got 15 groups signed up under NDAs. These would be export credit agencies, commercial banks that still lend in the mining space, and some of the private debt lenders as well. And the way in which we envisage this going forward is that they're currently conducting high-level due diligence within the VDR. Some of them have already visited site. By January of next year, after they've done 3 to 4 months due diligence, we will request proposals from the group of 15. Once we see those proposals, we'll then whittle that group down to 4 or 5, which will then become the main project debt syndication group. At the end of the first quarter, we bring in the independent engineer, and then over the next sort of 6 to 8 months, as we complete the bankable feasibility study and the final amended permits to construct and develop the mine are in place, we would hope to announce project financing on the debt side in the third quarter of next year at the time of release of the bankable feasibility study. And then, as your listeners will know, once we have the debt commitment letters in place, we then have to turn our attention to the equity component, and we have to raise the equity component. There's also an offtake that would be available here, which I think could be a significant part of any project financing. And then once we have all of that in place, we're at a point in time where the project is fully funded, and we can make a final investment decision as to whether we want to greenlight the project at the end of 2024. If we can move into 2027 and start that construction and development, then we can see first copper cathode here being plated in the second half of 2029, which is a relatively short period of time for a copper mine that ultimately will produce in excess of 100,000 tons of cathode a year.
Okay, very good. Yeah, that's a very helpful timeline. So as far as the permitting side of things, you have to amend a few permits that you currently hold, but what other permits are still outstanding?
Yep, so we have to amend the aquifer protection permit, and the industrial air permit is another amendment. And then there's a dust permit that will have to be amended with the local municipality. And then the last permit that will require an amendment essentially is the mine land reclamation and bonding permit. And we would envisage that coming into place once the project financing is there, giving our bonding requirements are likely going to increase over and above what we have currently. So as I said earlier, because the plan's not going to principally change between now and the bankable feasibility study, we're actively making out the applications as we speak to have those permits amended. Those applications before the end of November will get into the various state and municipal regulatory bodies. We then envisage that they're going to take maybe 1 to 2 months to review the applications and then administratively accept them sometime before the end of January next year. And then, as the listeners know, because there's no federal nexus here and we're on private land, once that process begins within 6 months, the regulator by law must give us a response to our permits. So we envisage by June or July of next year to be in possession of all of the key major permits required to construct and develop the mine.
Can you say that last part again?
In the third quarter or by the June and July of next year, we will be in possession of all of the final amended permits to allow us to construct and develop the mine once the project financing is in place and we can sign off on a final investment decision.
Okay, so project financing, permits, and then the bankable feasibility study, and then in Q4 you press the green button and you start to build the mine.
Absolutely. Yep, that's the game plan.
Okay, that's a pretty clear game plan. Let me just dig in a little bit on the project financing side and see if I can learn something.
Yep.
The debt component.
Yeah.
How big a percentage, do you expect that will be of the
Yeah.
total financing package?
Well, look, the debt lenders, particularly the commercial banks, they take a very conservative point of view when they're lending, hundreds of millions of dollars, rightly so. So when we come to stress test the model, we take the floor copper price down to $3.75. We don't use $4.25, and we certainly can't use $5. And when we look at various things like the debt service coverage ratios and the long life coverage ratios, and we look at, what those should be, we can see that at the moment, 60% debt to 40% equity is probably the debt to equity split that we would be looking at a $3.75 copper price. Now, once we get the main project syndication group in place in the first quarter of next year, if they determine that their floor copper price is $4, then there might be the possibility that we can increase the leverage or the amount of debt on the project and minimize, future issuance of equity, and therefore try and improve the economics for the shareholders on a NAV per share basis, which is really the critical component for all of us shareholders.
Okay, makes sense. And then you only talk about copper, at least I only see copper here in the news on the PFS. Are there any byproducts?
In this system, there's a small amount of gold, there's a little bit of silver, but there's also molybdenum. And, when Sarco had a traditional flotation mill here in the 70s and 80s, the gold and silver actually went out in the concentrate. They never put a molybdenum system into the flotation mill. So again, that either went in the con or out into the tails. Unfortunately, at the moment, there's no proven technology for recovering the gold, silver, or molybdenum from the traditional heat leaching that we're looking at the moment. But certainly further down the line, depending on, whether Newton were successful or not, if you pursued a traditional flotation mill and went after the primary sulfides, and make a concentrate, you would be able to recover some of the gold, silver, and molybdenum if you ever put a traditional flotation mill in place.
I see. Yeah, it would be nice to recover that gold, George.
It certainly would at $4,000 an ounce. I might have to go out there myself and start doing a little panning of gold in the old dry stack tailings.
Yeah, for sure. Look, single asset junior producer, obviously your cost of capital is going to be higher than a major mining firm. It's just how it is. Doesn't this asset just make sense that it should be in the hands of a major mining company?
Possibly, but I think in response to that, that I've built this executive team and the project team with the skill and the bench strength to actually move this project forward ourselves and put it into production. But if somebody out there believes ultimately that the asset is better in their hands, then they can step forward and they can put a competitive bid on the table. And if we deem it, better than the go it alone plan, we're very happy to take that to our board and ultimately the shareholders. We're not an entrenched management team. We're here to create maximum value for the shareholders of the company. But at the moment, that maximum value comes from building this mine, de-risking it, putting it into production, and creating a solid mid-tier copper company in the heartland of the Arizona Copper Belt. As the listeners will have heard from me before, in business, successful business, timing is everything. And sometimes you need a little bit of good fortune. And a lot of times you make your own good fortune. And I think our timing on this is going to be exceptional given its copper cathode for US industry at a time of rampant demand within the US for a critical mineral. Modern society today cannot exist without electricity and all of the great, electrical devices that we have in our modern world, and copper's absolutely going to be required if we want to advance technology and move to a 22nd sort of century.
Very good. Final question, George. I mean, you just made the point about Made in America copper cathode in the Arizona copper belt. I mean, that's what Cactus is essentially. A lot of American jobs stand to be generated from the construction and operation of Cactus over the next 20 to 30 years. We've seen the administration make investments in MP and Trilogy. Are they going to make an investment in you?
Well, we've been to Washington and we've met with various government departments. We certainly could avail ourselves of federal monies. The one caveat we have at the moment, however, is that because we're on private land, there is no federal nexus, and it really streamlines, as we touched on, our permitting process. Any companies at the moment that are availing themselves of federal monies have to go through some form of federal government regulatory review. Now, what that entails, we don't quite know. So certainly we're considering accessing federal monies, but at the same time, I don't think we'd want to take federal monies off the table and then get trapped, let's say, in a NEPA 404 review, and suddenly the timeline of the project gets pushed out by 1 to 2 years, and we miss that first copper cathode production. So I think we'll be submitting applications for access to government loans and grants, but we aren't necessarily obligated to take those monies. And let's see how things shake out in 2026 with respect to what type of overview would be required from the US federal government if we were to actually draw upon those funds.
George Ogilvie, thank you for your time.
Thank you, Robert, for the opportunity.
Cheers.